Good afternoon, everybody. Thank you very much for the introduction, Gray. I would like to point out that this webinar is being recorded, and so anybody can access it or refer friends to it afterwards. Gray will have it up on the Emeritus College list of available webinars, and also I'm very willing to share my slide set with anybody. I'll give you my email address at the end of the seminar, and anybody who's interested, just send me a note, and I will send you the slide set. So you don't need to take any notes. So I'm going to share my screen now with you, and hopefully we can see the cartoon there. Right. So it used to be that in Britain, the afternoon show from Listen with Mother used to start off, "Are you sitting comfortably? Then I'll begin." But maybe we should go and get a glass of wine or a beer and sit comfortably. And then when we transition into the discussion of what's going on in the world today from the financial point of view, we should switch out to hard liquor. Let's see how that goes. So I'm having a little problem with my slideshow, sorry, of moving. There we go. As Gray mentioned, there are a lot of people who will come and give you lectures on finance and how to handle your finances. And they all have implicit biases and something to sell, even if they're not actually selling you anybody. Say you talk to the Vanguard representative or the Fidelity representative on site, then they still have the potential for having biases, even if they say they don't. So I am hopefully going to give you some unbiased information, and also I'm going to express my opinions. So my opinions are exactly that, and any action you take on anything I say is entirely of your own volition, where if you think my arguments are good, then follow them. If you think my argument's not good, then please ignore them. So my personal experience, as Gray mentioned, is I'm a physician who worked at Emory up until a couple of years ago. I have an MD, a PhD, and an MBA. I have experience running an investment fund, which is something I did over the last few years. It's currently on hiatus as the market goes up and down in a crazy manner. I have a reasonable knowledge of statistics, and I performed the retirement calculations for myself a couple of years ago, and I realized that we are great at what we do. We may be great at Shakespeare, we may be great physicians, but a lot of us are relatively unsophisticated about money and how to manage it and how to plan for retirement. So what I'm going to do in this seminar is talk about, I've been saving all my life. Do I have enough? What will Social Security give me? And you also need to think about, what am I going to spend my money on in retirement? And one of my themes is that really in the early years, you're probably going to want to spend more money than you will in your later years, because you're going to want to take that round the world cruise or whatever. And then as you progress through retirement, your horizons are going to close in a little bit, but then you also need to be certain that you have enough money for any medical support and medical care that you might need. So think about what you're going to be spending your money on when you retire. So some of the things that we're going to cover in this seminar are what is asset allocation, what is the future value of money, what is Monte Carlo simulation, and how do I deal with market catastrophe, which is the current situation that we're facing. I forgot to mention, please submit questions through the Q&A function in Zoom, and Gray will read those at the end of the seminar. We're going to take 2 question periods. I'm going to, after we've dealt with the section on market catastrophe, I'm going to take a series of questions, and then if people are still interested, I'm going to run some Monte Carlo simulations, and you can see how powerful a tool this is, and it's free and easy to use. Monte Carlo simulations are actually a statistical technique that were developed around the time of the atom bomb project, and deals with running through a multiple series of scenarios and coming up with a probability of outcome. And that's what you want to be able to do with your retirement money. So I think that in order to do this process, you should estimate your expenses, your fixed and variable, add up your assets, your savings, your retirement funds, your annuities, and your social security, and then you should run a Monte Carlo simulation and see what the outcome looks like. And you can do this at any stage in your life. And in fact, my recommendation is that you can't, even if you're 30 years old, you should start doing this. And you should do it at least once per annum. And so you can see whether you're on target for a successful retirement, even if you're 30, 40 years away from retirement. And first of all, work out your expenses. There are plenty of expense sheets on the web, and you can probably find an Excel template, but you need to know what your essential budget items are, what you're spending on meals, personal care, what your future liabilities are in terms of home improvement, what you want to spend, how much do you spend on your health care, your discretionary travel, and then you get a good idea of what you need in retirement. You know, have you paid off your mortgage? Will you still be paying a mortgage? Do this first. You're going to need to sign up for Medicare, and Medicare is an extraordinarily complicated system. There are multiple parts of Medicare. Part A is hospital care, and this is free in quotes. You sign up for this when you reach retirement age. If you're continuing to work, I think, but I'm not certain, that you can defer signing up for Part A. When you retire, then you must sign up for Part B, which covers everything else that Part A doesn't cover. And Part C, Medicare Advantage plan, is kind of an HMO version of Part B. And Part D is for drug coverage. And there are many other parts of Medicare that you need to look into. I'm not going to go into this in any more detail, except to say that Part B may be more expensive than you think when you retire. So it's taken out of your Social Security payments, and it starts at $190, and it's essentially means tested on your last year's tax return. So if you earn a lot in your last year at Emory and then retire, then the Part B insurance can be a lot more per month than you were expecting. It can go up to $460. So let's look at one issue that I think is confusing and confuses a lot of people, and that is when to turn on Social Security. And I'll give you the conventional view and my view on this. And so I'm a retired anesthesiologist, so let's consider John, who's a 66-year-old anesthesiologist. He's going to keep on working until he's 70. He's got plenty of money to retire. He is qualified for full Social Security, and so he can draw approximately $45,000 a year now for self and wife, and he can draw 132% of that. It goes up by 8% per annum from your full age to 70 and a half when he's 70. What's the better deal? When should you turn on Social Security? And I would emphasize that this scenario is for somebody who is working, healthy, and has enough money to retire and is not actually going to be dependent for daily living on Social Security. If you're going to be dependent on your Social Security income for your daily living, then this really won't make quite as much sense. So as I said, this is a healthy person who's retiring in the 66 to 70 range. And if you've got an illness or other circumstances, you're taking care of somebody who's sick, different solutions may apply. You need to know that the retirement age is changing. The full retirement age as defined by Social Security is changing. So if you were born between 1943 and 54, the full retirement age is 66. But from 1955 onwards, it's going up over a period of 5 years until 67. So take note of that and know when you reach full retirement age. If you take Social Security early, before your age 66, it will cost you about 0.5% per month for each year that you do it earlier. And if you wait until after 66, it increases by 8% per annum. If you're still working, you need to wait until at least full retirement age. Otherwise, your Social Security payments are reduced dollar for dollar. You earn $10, Social Security payment is reduced by $10. So unless you have an urgent need for income, you should wait until at least after your full retirement age before you turn on Social Security. And the time you turn on Social Security is entirely up to you. So when do we break even? This graph comes from Schwab. I'll show you the website in a moment. So you've got 3 lines. This is starting Social Security. The light green line is at age 62. The blue line is at age 66. And the reddish line is starting Social Security at age 70. And what this looks at is the cumulative dollars that you receive from the Social Security system over a period of over the different ages. So if you start your at 70 versus starting at 66, you can see that those lines cross at about age 82. So the actual number of dollars that you receive by deferring your Social Security doesn't catch up with you until you're age 82. I'll repeat that slightly differently. So you turn on Social Security at 66 to start receiving the dollars, and versus turn it on at 70 and receive 132% of those dollars. The crossover point when you'll receive more money for retiring at age 70 is at about between age 81 and 83. So I would ask you to think about the question yourself: when do I want that money? When do I need that money? If you want the money earlier, then take it earlier. If you have need of the Social Security income when you're around 70, then delay it. So the conventional wisdom is that if you can afford to, you should wait until you're 70 and a half before turning on Social Security. As I said, the crossover point is around 82 to 83 years in actual dollars. So why not take the dollars at age 66, invest at 5%, and after 4 years, you've got another $55,000. When do you anticipate needing most of that money? I turned my Social Security on when I reached full retirement age, and I think that was a sensible decision, because you want to have the use of the money now, and I think you need the money less when you're age 82 or 83. So if you want to find this chart, the website is up there, and as I said, I'm happy to share my slide set with anybody. You just have to send me an email after this webinar. And if you Google Schwab when to take Social Security, you'll find this white paper. Let's talk a little bit about financial advisors. At the end of the Obama administration, there were proposals that financial advisors must all be fiduciaries. And what does that mean? A fiduciary is somebody who is required to act in your best interest and not churn investments, for instance, not work to maximize their commissions on their their work for you. So the first question you should ask a financial advisor if you go to one is, are they a fiduciary? And if they say no, but I work for you, then run a mile. They must be a fiduciary to be safe. Who are they working for? Are they working for a big company like JP Morgan, Raymond James? Are they working for, are they independent advisors? And there are kind of three structures for a financial advisor. Fee-based. They will work for you on an hourly fee and not necessarily manage the money, and give you an advice on an hourly fee basis. There are people who work on commission only. They are taking commissions from the products that they sell you. If they sell you life insurance, then they get a commission on that life insurance. And then there are financial advisors who work on a hybrid basis, partly fee-based, partly commission. My advice, if you're going to a financial advisor, is to get somebody who is fee-based, and they will be able to give you financial advice that is tailored to you, because they're not running the money for you, and they're not driven by commission. Even if somebody's a fiduciary and getting paid on commission, they have certain biases may creep into their recommendations for you. So my advice is to go to a fee-based financial planner if you can, and if not, talk to them about whether they're fiduciaries, are they working for you, are they, how do their commissions work, and choose your financial advisor carefully. So let's talk a little bit now about asset allocation. What's in your portfolio? You've got some stocks, you've got some bonds, and you've got some annuities in there, probably. And let's talk about a rational allocation and how you should manage that portfolio, whether you've got a financial advisor or doing it on your own. Should you hold individual stocks or time the market? My answer is no. I don't think that you should hold individual stocks unless it's kind of, if you're not playing money, unless you're gambling. You know, I don't trade in Tesla stock. I, in fact, don't own any individual stocks. All my money is invested in ETFs and mutual funds, and we'll talk about those in a minute. There's a theory called efficient markets in which the theory is that all share prices reflect publicly traded knowledge instantaneously, publicly available knowledge instantaneously. And so the efficient market hypothesis says that the market is rational, it takes all known information on board, and that is reflected in share prices. I'm not sure that's true. I think the market is irrational in the short term. And we've seen that over the last few days, where you get swings of 5–10% in one day. Think what those swings mean. A swing of 5% down means that it's wiped on average 5% off the value of every single company in America. So I think the market is irrational in the short term. The other thing is that we don't get mansplaining from pundits, we get retrosplaining. And you will see, at the end of the day, you will see market reports that say, oh, the price of oil crashed and the market declined 10% in response to that. That is probably true. The market jumped a couple of days ago on the anticipation of the stimulus being passed. When you see other days, you see market movements that are really only explained at the end of the day by the economists and the newspaper writers going around and saying, hey, why do you think the market moved today? So it's retrosplaining. You won't see anybody who can consistently wake up in the morning and say, I believe the market is going up today. And you can't predict the market really in 1 minute, 1 day, 1 hour, 1 year, except to say that over a long period of time, the market generally tends to go up. So where should you put your money? I think you should put your money not in individual stocks. You should have low-cost mutual funds and exchange-traded funds, and you should consider target-dated funds. I'm not sure that target-dated funds are the best thing for a sophisticated investor. If you look on the Fidelity and Vanguard websites, you will see that they have target-dated funds for the date of your retirement. And what they do is they gradually shift the allocation from stocks to bonds as you get closer to retirement. I think that's a kind of one-size-fits-all fund. Their performance is not necessarily the greatest. I've not really looked at their fees recently. If you don't want to mess with anything yourself, then target-dated funds may not be a bad idea. But I think that I'm talking to Emory faculty who should be reasonably savvy and work either with a financial advisor or on their own to structure a portfolio that makes sense for their risk tolerance and exactly what they want to do. How much of your portfolio should be in bonds? Well, conventional wisdom, and you'll see this in a lot of financial magazines and reports, is that the age should be the percentage of bonds that you hold in your portfolio. At age 40, 40% of bonds. Age 70, 70% of bonds. However, over a long period, stocks will outperform bonds. Over any long term, stocks return an average of about 7%, and bonds return an average of about 4.5%. So if you're age 30, I don't think you should be investing too much in bonds at the moment. If you're age 70, then it's obviously a little bit different. But I think that when you look at this over any long period, stocks outperform bonds. So if you're a fair distance away from retirement, I would go light on the bonds. And if you're closer to retirement, then think about increasing the bond portfolio. So if you've got a 5-year or longer window, consider more stocks. If you've got a shorter window, consider more bonds. You need an asset allocation, and this is an asset allocation that has 40% invested in the S&P 500, 10% in mid-cap stocks, 10% in small-cap stocks, 20% in international stocks, and about 30% in bonds. And if you want to go lighter on bonds, then you can decrease the other other four proportionally. If you want to go heavier in bonds, if you want to go lighter in bonds, increase the others proportionally. If you want to go heavier in bonds, decrease those proportionally. I made this slide a year or so ago, and it might have changed, but the Vanguard Total Stock Market Index Fund has returned 9.78% per annum since 1992. If you just want one fund, that might not be a bad choice. Look at the performance, say, of the Vanguard Stock Market Index Fund compared with the Fidelity or the Vanguard Target Dated Retirement Fund, and see how they've been doing in comparison to each other before you make those kind of choices. So one of the reasons for holding bonds is that it cushions you against shocks in the market, compared with having a total stock portfolio. If you're 30 years old, you can deal with the shocks in the market that we're seeing now. If you're 65 years old, then it's more of a problem. And so I wanted to look briefly at how an asset allocation portfolio that looks pretty much like this, except it's in 38% bonds. This is my own portfolio, and I did this on 19th of March. So my retirement portfolio is roughly as described on the previous slide, but 38% in bonds. And so on March the 19th, the S&P 500 was down 25% year to date, but my portfolio was down about 19%. So it did about 25% better than the S&P 500. And that's a good example of why you want bonds in your portfolio, to cushion the blow for a sudden decline. The converse is true as well, obviously. When the market picks up again, your return will be slower than the stock market. And so you need to think of what your risk tolerance is. Can you afford to take a 50% decline in your portfolio? Will you lose sleep? Then you may consider yourself to be a more conservative investor. Can you deal with this in, is this going to cause you serious angst and you're going to lose sleep? Then more bonds. Annuities are a problem as far as I'm concerned. They're very complicated. They have a lot of riders on them. They're expensive. You're spending a lot of money for fees for the person who sold you the annuity, and they have internal fees. A value of an annuity is usually fixed and doesn't go up with inflation, although you can get some inflation protected annuities. That's another rider. It costs you more money. And they provide income stability in down years. And that's especially important now. If you've got an annuity with a fixed payout and you're retired, then you should be reasonably happy, because that is guaranteed for a number of years or for the rest of your life, depending on how you set up the annuity. But overall, you need to look very carefully at any annuity that anybody's going to sell you. ask the salesperson what is their fee in the first year, what is their fee in what is their commission in the first year, what is their commission in subsequent years, what are the internal fees, how much is each rider going to cost you, and then when you know what the guaranteed payment is, look at taking that sum of money and investing it at, say, 7% over the same period of time, and look at the return you get. I also have problems knowing what to do about long-term care and whole life insurance. Again, I would ask the person who wants to sell you a whole life insurance policy to perform a future value calculation for the dollars they're asking you to invest. So if they ask you for $10,000 for this life insurance policy, which is going to mature and start pay out when you're 67, ask them to take that same amount of money and invest it at 7% or 5% or 6%, whatever you choose, and see how much money you have on the same date. Because of all the fees in the whole life insurance, you will find you'll always be better off investing it than buying a whole life product. If you need life insurance for some reason, like you want to protect your mortgage and you want to make sure that if you die, your spouse can pay off the mortgage, then buy term insurance, but don't buy a whole life product. Long-term care is another issue which you need to consider as you approach retirement. And long-term care insurance ties up a whole lot of dollars which you can't access and gives you very limited coverage. You need to look at how many dollars this care insurance is going to pay out over what period of time and decide if it's really worth your while or whether the money is better sitting in your retirement account when you can monitor it, when you can decide where to spend it, and when you want to convert that to paying for a retirement facility. So, have I got enough money to retire? Here's a quick and dirty calculation that you can do. We worked out on the beginning of this talk, you know what your expenses are. And you take 5% of your total assets, and that is roughly what you can spend per annum and not run out of money. So you've got 1 million saved, you can spend 50,000 per annum. You've got if you take a flexible approach, spend more in a good year and less in bad, then that might be helpful. But I'm going to come on to describe a much more sophisticated and easy to use way of solving this question, have I got enough money? And we're going to run at the end of this talk some Monte Carlo simulations, which is a statistical technique that takes your input parameters and models many outcomes, and gives you a probability of success. It's only as good as the inputs you put into it. But if you go to a financial advisor, they will be doing this for you, but you can do it yourself, and I'll point you to a site where it's free, and we'll run some simulations at the end of this seminar. So before we get on to the Monte Carlo simulations, I want to look at the current crisis and see what we can do and make some recommendations about how we should be looking at this and managing our money over the next 6 months to a year. So, is the sky falling on us? Well, the Chinese experience seems to be about 3 months of pain. Oh, actually, before I get into this, I should say two things. I'm going to stop after this brief discussion on the current financial situation and take a series of questions before we do the Monte Carlo simulations. So if you've got questions, type them to Gray now, and he's going to ask them. And secondly, we're talking about finances here. I want to recognize that this is not a financial problem. This is a problem, a pandemic where people are dying, where medical systems are being on the verge of being overwhelmed. And I feel incredibly proud of the physicians and healthcare workers everywhere, especially at Emory, my colleagues who are putting their life on the line every day. And I think we need to just take a moment to remember and be thankful for the healthcare workers, and not only the healthcare workers, the people who are stocking the shelves in the supermarket, doing your Instacart deliveries. I mean, there are people who are working really hard and putting themselves in harm's way, and we need to appreciate them. So anyway, back to what I was saying. The Chinese experience in Hubei province and Wuhan seems to be about 3 months with a severe lockdown. And we need to worry about Italy, which is several weeks ahead of us in terms of the progress of this pandemic. And their medical services are overwhelmed, and the economy has essentially ground to a halt. How do we compare with the Chinese experience and with Italy? Well, apart from the big cities, New York being the prime example, our population is more dispersed, and we're not living as close together as people in Hubei and northern Italy. But on the other hand, our social distancing measures are much less restrictive than Italy and China. You know, Italy is putting people, is requiring anybody who's moving on the streets to have a printed sheet with a reason for moving, and if they're deemed to be moving inappropriately, they're going to be fined and maybe go to jail. So the American population is more dispersed than Hubei and Italy, but our social distancing measures are really much less restrictive. So we need to flatten the curve of the pandemic. And I'm talking about this really just to put it in context when we consider the economic implications. If we flatten the curve, it will probably extend the duration. So the best guess is that this is going to be a 2 to 6 month crisis with all economic activity at a standstill. We are not seeing much in the way of economic activity anywhere at the moment in the world, in America. So what does this mean for our investments? And the other thing to worry, to be concerned about, is this may be only the first wave of COVID-19. I think the healthcare system in Africa is very primitive, and maybe they will have a peak with a lot of people dying and it'll go away. But I suspect that there will be reservoirs of this virus in populations, and once people start moving around again, we may get other subsequent waves, and they may not be as severe, but that's something to be concerned about. This is from the New York Times today, and Trump wants to reopen America by Easter. So this is what happened. This is some epidemiologists modeling of what's going to happen. So we social distance for 14 days. So if we do that for 14 days in the USA, then the prediction is that there'll be 128 million total infections. If we social distance for 2 months, then there will be around 14 million total infections, around 10% of that. So I think our president is being optimistic when he says he wants the United States raring to go in 2.5 weeks. And I don't think this is a realistic option for us. I think we're going to be social distancing, and the economy is going to be pretty much shut down for 2 to 6 months. This is another slide from the New York Times today, and it's looking at the unemployed claims for the last week versus since the turn of the century. If you look at the financial crisis in the 2008 recession, the weekly unemployment claims were running around 500,000 per week. If you look at last week alone, there were 3.3 million unemployment claims. There's never been anything like this in the United States. That's a huge increase. So economists are suggesting a poor second quarter with a recession and a quick recovery. Whether the digging out from the recession will be V-shaped, that is a very fast recovery, or U-shaped, where there's a longer recovery, is open for debate. But we're looking at a second quarter that is pretty much wiped out. I can't see wiped out from the point of view of economics, not from the point of view of pandemic. There's going to be very little economic activity. I can't see anything good about the next 2 to 6 months with no economic activity. I worry that markets may fall substantially further than they've fallen at the moment. I think what you're seeing with the last 3 or 4 days of last 3 days of increases is what's known as a dead cat bounce. You're seeing a response to the stimulus package, but and it's obvious that the government is going to print money as fast and as hard as it needs to keep the economy ticking over. But think of some economic indicators that are around us. How much money have you spent in the last 3 weeks on going out to dinner, the theatre, planning travel? Delta has grounded 70% of its flights. Disney has shut down parks and cruises. Hotels are closing. The New York Hilton is closed. So we're wiping out the second quarter. We're partially wiping out the third quarter, because even if it's a quick recovery, Q3 isn't going to be great. You're going to see American GDP, gross domestic product, dropping somewhere around 25% this year, maybe more. I mean, it's really scary. So what are you going to do? If you've got more than 5 years of to retirement, economists are suggesting that you do nothing. Max out your contributions to your retirement, because this is going to come back. If you have cash on hand that's not doing anything, and you're thinking about what to do with it, consider gradually investing over the next few months. You may make very good returns. On the other hand, you may want to make a partial move to cash because, as I said, I don't see any good economic news coming in the next 2 to 6 months. You shouldn't time the market. Do not attempt to time the market. That's the road to ruin. as I said earlier, you can't predict what's going to happen in the market in 1 minute, 1 hour, 1 day, or 1 year. But if you decide to go partially to cash, then a restart of the economy may be a good time to start reinvesting and start seeing economic activity starting up again. If you move partly to cash, then you should start reinvesting. If you're 1 to 5 years away from retirement, it's a little difficult to know how to manage this. One option that you have, assuming you're in good health, is to delay your retirement for 1 or more years to catch back up to where you thought you needed to be for retirement. You should you should make sure you're maxing out your contributions. You want to put in as many tax-free dollars as you can. And again, you might want to consider, if you take my pessimistic view of the markets over the next 3 to 6 months, moving some of your investments into cash and re-entering when economic activity starts up again. As I said earlier, these recommendations about moving to cash are my own pessimistic view of what's happening in the economy, and I don't see a positive bounce back in the stock market over 2 to 6 months. And you need to review the material that's available, listen to the economists, and make your own decision. I'm retired, now what? Well, you can do a few things. You can cut your discretionary spending, and I bet a lot of people are doing that. As I said earlier, I don't think the market's hit bottom yet. And more so than the 1 to 5 year and the more than 5 year people, you should make a partial move to cash. General advice is that you should have around 6 months to a year's cash on hand. So think what happens if you're living off your portfolio, your retirement portfolio. You've got some money coming in from an annuity, and it's 1929 again. In 1929, the stock market dropped 90%. I'm not saying that that's going to happen again this year, but you need to make sure that you have enough cash on hand to see you through a period of several months of market catastrophe. So I would advise retired people to take a partial cash position. And indeed, I'm retired. My portfolio has been hit hard, and I have moved partially to cash. What I'm going to do now is stop talking and take questions that have come up during this part of the presentation, and then we will go on to the Monte Carlo simulations and how you can use this really simple tool to answer your question about, with my situation, have I got enough money? So my email address is at the top of this slide. I'm happy to share this slide presentation with anybody who wants it. I'm happy to answer any individual questions or deal with specific individual situations that you don't want to ask in public at the end of this seminar by video or by email or video conference. And I want you to note this website, flexibleretirementplanner.com. I'm going to bring up the Flexible Retirement Planner, which we're going to use in the next part of this seminar. And I'm going to stop now and ask Gray to read out the questions that we've got, and we'll try and deal with those and then come back to the retirement planner. I'm happy to stay around for as long as people want to listen and stay in the seminar. I'm not going to be offended if people check out now, but I think it's worth looking at this software, and we'll do that at the end of the first series of questions. And then afterwards, I'll take another series of questions at the end. So Gray, over to you. What are people asking?
Okay, here's a question, and there was a slight modification of it later. This question was asked a while ago, and so you've certainly dealt with some of it, but I'll let you decide what you want to say. What is your approach to a retirement account as we experience this COVID-19 crisis and the worldwide economic disaster attached to it? Should we do nothing? Should we do something? And and then the modification, I'm referring more specifically to a 403B account.
As I said, it really depends on how long you have until retirement. If you're more than 5 years out, then you're hoping that we'll get back to where we are at the moment. You have the ability in your 403B account to change your investment mix. If you're closer to retirement, or even if you're not, my personal view is that it's not going to get better in 2 to 6 months, and I want some cash there which I can decide to reinvest at some point in the future. The risk of having cash is that you miss the turn and the upside, but I don't think that's necessarily a huge problem. You can't time the market exactly. There's been a big jump in the market in terms of the economic stimulus. So if you want to make a partial move into cash, today or tomorrow is pretty much a good time to do it, because I don't see anything good coming in the next couple of months.
Okay, and here's a question. How is a TIAA financial advisor paid? Are fees taken out of your funds?
I don't know, to be quite honest. I think, and I'm not certain about this, I think for the people who are on campus, who come to campus for Fidelity, Vanguard, and TIAA, I think, but I'm not certain, are paid salaries. And that makes them somewhat better at giving you advice than somebody who is compensated by commissions on the products they sell you. But when you meet with your tier or your Vanguard or your Fidelity representative, then you ask them that. How are you being paid, and are you a fiduciary? Those are the two critical questions that you need to ask them. As I said, I think, but I'm not certain that they are salaried.
Okay, here's another question. I found that one's marital status and partner's income are a major factor in determining distribution over time, as well as age of spouse. Your recommendations position one for a spouse that has not worked. Did you consider that into your allocation and distribution? Did you consider that into your allocation and distribution of stock and other equities?
Can you read that again?
I found that one's marital status and partner's income are a major factor in determining distribution over time, as well as age of spouse. Your recommendations position one for a spouse that has not worked. Did you consider that into your allocation and distribution of stock and other equities?
Yes, I think that your stock and equities and bonds are something that you and your spouse need to work on together and do as a couple. Let's take an example of two people who are 30 years apart in terms of age and our family unit. I think that you need to, that's an extreme example. The asset allocation model holds up for most people under most domestic circumstances. I would consider, if you've got a big disparity in age between two people in a partnership, that one retirement account should be holding more bonds than the other for the older person. But I would consider your family assets as a whole and plan as a unit for the two people who are working with those that asset set.
Okay, here is another question. Emory has recently announced new 403B retirement options at Fidelity Investments, TIAA, and Vanguard. What are the implications of these changes for our retirement accounts? Who would you recommend that we reach out to for better understanding the individual implications? Should we use the vendor contacts? And before Peter starts, I'll just say that those changes have been postponed. And so even though you probably got a big or small folder mailing within the last few days, those changes have been postponed. But Peter, you might want to say something about that otherwise.
Yes. As far as I understand this, and I have not received the letter or the folder or anything on this, maybe my mail is delayed. Emory, I knew, and I had discussions with Gray, that Emory was going to change some of the funds that were available to participants in the 403B plan, and we're going to map some of your funds to different funds. So if you had Fund X, which was being discontinued, it was automatically going to map to Fund Y, which was the replacement fund. And these changes, I understand, were being made by Emory to consider what they thought were better options for your money. But I would point out that if Emory decides to go ahead and make these changes, you have the ability, and it does take some work on your part, to move the fund that you love that is about to be cancelled off into the brokerage window and keep it. So as far as I understand this, the Emory 403B plans, certainly with Vanguard and Fidelity, I think with TIA as well, have a brokerage window which allows you to do pretty much what you want with the money. And you can go ahead and take the fund that you love, if Emory decides to discontinue it in the plan, and move it and make your investments through the brokerage window. You can do a lot of other things through the brokerage window. If you feel that if you want to invest in ETFs or mutual funds that are not available, then you can do that through the brokerage window. So my idea is that if Emory does decide to go ahead and do this, look at your funds and take a reasoned approach to the new fund. Does it look good? Does it look better? Are the fees higher? And if you don't like it, move your money into something else via the brokerage window.
What might be the impact of the increasing national debt on retirees?
Oh, yes. So what's the government doing at the moment? It's printing money. The stimulus package is I think it's equivalent to about 10% of GDP. Government is printing money. What's that going to do? Is that going to cause runaway inflation? I don't know. The last time we saw the government printing money was in 2008, with TARP and the bond purchases, Troubled Asset Relief Program, and it didn't actually lead to a lot of inflation. I mean, typically, when you look at countries like Argentina and the Weimar Republic, printing money results in inflation. That's not necessarily so at the moment. So how can you protect yourself against this if you're a retiree? Well, you can't really. You're going to have to deal with inflation. And when we come into, for those of you who stick around for the retirement planner session at the end of these questions, you will find that it is exquisitely sensitive to inflation.
Okay. And for people retired now, what specifics on partial move to cash are you suggesting? 1 year's expected spending or a specific total percent of the portfolio?
Depends on what you think is going on. I think you should have an absolute minimum of 6 months cash to be able to cover your expenses from your cash account for the next 6 months without worrying. 1 year might be better. My personal view is that I've moved 50% of my retirement savings across the board into cash. When you don't know, you can't be certain what the right decision is. The right decision might be to do nothing. We will see. I'm wrong. Trump is right. The government will, the country will reopen for business in 2 weeks' time, and I'll be looking foolish. Or the alternative view is that a major catastrophe is about to befall the economy, and I look really smart. So under those circumstances, I think I'll go halfway. I'll go 50% into cash in case I'm wrong, and I'll take my lumps if I am. So the answer to that is 6 months minimum, a year's better, and see what you think is going to happen to the economy and make a decision based on that.
And this is a question from a different person, but I'm not sure what moving to cash means. Does it mean getting money into one's bank account? Any chance that banks might fail?
Yep, there's a chance that banks might fail. And let me be more specific. If you're retired, you don't want to, and I should have explained this, and I apologize. You don't want the move to cash to be taking money out of your retirement account and putting it in your bank account, because that will have a significant tax consequence. What you should do if you want to make a move to cash is move your money from whatever it's invested in to a Vanguard, Fidelity, or other money market account. So by cash, I mean a money market account within your 403B or within your IRA. So take your money and put it in a money market account, which you can then, when you want to draw money, you take it out of that rather than selling your stocks. I hope that's clear. I apologize for not mentioning it earlier. Do not take the money and put it into your bank account because that will trigger a tax liability for next year. Take the money within your retirement account and move it to Vanguard, money market, Fidelity money market, and you can find those funds easily and on the respective websites. I hope that's clear.
And then another question about that, doesn't a partial move to cash lock in losses from the recent drops in the market?
Absolutely, yes. It locks in your losses. Now, what's going to happen over the next 2 to 6 months? If the market drops another 30%, then you've saved yourself those losses. If over the next 2 to 6 months the market's up 30%, then you have indeed locked in those losses. And that's a decision that you absolutely have to make for yourself. I've locked in my losses because I think that we haven't seen the bottom of the market yet. And, you know, I'm no better than anybody else at making these predictions, but I cannot see how, with 3 million people applying for unemployment last week, we're going to see the market rising 30% in the next 3 months. I just can't see it. Yes, you've locked in your losses, you've saved yourself further losses.
Okay, if your portfolio is managed by a bank, Wells Fargo, SunTrust, etc., what is a reasonable fee? They charge by a graduated percentage of the value of the total portfolio. The larger the portfolio, the smaller the percentage. What is a reasonable fee percentage? Is this a good idea, or should I move to 403(b) accounts or TIAA?
It depends on the advice that you're getting from the bank and how much you value that. The wrap fee that a money manager will charge you for handling your portfolio is somewhere around 1%. I mean, if it's $100,000, it might be 1.5%. If it's $10 million, it may be half a percent. I don't know. It depends on your fee structure with the bank that's managing the money for you. And you need to decide whether that wrap fee is worth it for you. Is your financial advisor somebody at the bank who you're talking to, somebody you trust and value their opinion, and are making what you feel are appropriate recommendations? It might be worth paying 1% for that. If you are a relatively sophisticated investor, then you can do it in your 403(b). It just depends on how much you value that wrap fee. And as I said, I think they're normally in the range of 0.75% to 1.5%. It depends on the institution.
Okay. What are risks of hyperinflation with the government printing money and reduced production of goods in the coming year due to COVID-19? How does one protect against hyperinflation?
Yeah, I don't know. That's why I said we don't know what's going to happen in terms of inflation. And I'm not really sure how one can protect against hyperinflation except going to gold. If you think there's a risk of hyperinflation, traditionally gold has been the preferred asset. But really, when you think about it, since America went off the gold standard, gold has really no more intrinsic value other than people value it more than cash. There's somebody I know casually who keeps a large amount of gold in his safe. Maybe you should do that. That's probably the best hedge against hyperinflation, precious metals. You might consider other precious metals that are needed for the technology industry. You know, I think the best hedge against hyperinflation is going to be gold.
Okay, and this is the last question of the ones that have been submitted. I was married for 16 years, both of us worked, and then divorced. I understand that I have access to my ex-husband's Social Security payments upon retirement. What is your advice for how and when I should take those distributions if he was more than 10 years older than me?
You'd have to, that's a relatively complicated question. And I think that you would have to look at the implications for the Social Security payments, or depending on what your current salary is. So if you're currently earning and you draw your husband's Social Security, you need to check whether this reduces dollar for dollar against your current earnings. If it does, then for heaven's sake, don't take them until you stop working. Once you stop working, then and you're reasonably financially secure, my advice is to take them when you reach full retirement. Sorry, I misspoke there. If you're below full retirement age, then if they're reduced dollar for dollar, it makes no sense to take them. If you've reached full retirement age and you want the money and you're financially secure and not worried about the guaranteed step up of 8% per annum, then take them when you reach full retirement age. But actually, today, a guaranteed step up of 8% per annum isn't looking too bad until you're age 70 and a half, is it?
Okay. So those are all the questions that have been asked up to now.
Okay, well, let's move on then to how to look at your own personal situation. And I'm going to run some simulations for you using this program called Flexible Retirement Planner, and you can find it at flexibleretirementplanner.com. And there are other free Monte Carlo simulations out there. I'm using this one because I find it fairly easy to use, and it works well for me. So I'm going to enter a series, I'm going to run two scenarios, one for somebody who is young, and then afterwards I'll run a scenario for somebody who is older. And we'll look at some of the ways in which this changes. So let's take a 40-year-old person at the moment who has retirement age expected at 65, and they're going to live till they're 95. We're going to have 3% inflation, no standard deviation. The investment tax rate is 15%, and the overall income tax rate this person is experiencing is 20%. They've got a taxable portfolio of 10,000. They've got a taxable deferred portfolio, and by that I mean your 403B of 250,000. We won't worry about a tax-free portfolio. You can start withdrawing our IRAs at 66. They're young and spending all their money, but they're maxing out their retirement savings in their 403B at 18,000, and we're not doing a tax-free annual savings. They're moderate risk. They've got actually, let's change their risk to aggressive, because they're young. They're 70% stocks, 7% bonds, and 23% international. Their annual retirement income is going to be only Social Security. So in let's use the example of about $35,000. They're going to start retirement age 67, and they want to spend $100,000 a year. And their spending policy, you can change the spending policy to be very conservative, stable, or flexible. And let's see how this person is going to do. So we're going to run the scenario, and the probability of success using, I forget how many repetitions this does. I think it does either 1,000 or 10,000, is 78%. When you run this scenario for yourself, you want the probability of success to be in the 95% range. So what you can do when you see this, age 40, is you can start saving $10,000 a year. Let's see what happens when you save $10,000 a year. You've increased your probability of success markedly. And so when you're, for the 40-year-old person on this webinar, go ahead and do this for your own money and see what your probability of success is. Now, one of the things to notice here is the investing style. If you go to risk averse, you'll find that it will decrease, that's a conservative investment style, it'll decrease your probability of success to 68%. So with this set of parameters, you need to think about being aggressive in order to make those goals. And we're going to run that again, and you're going to get up to 89%. But if you're very conservative with your investment, you're not going to make it. The other thing, since we were talking about hyperinflation, is what happens to this probability of success if we double inflation from 3 to 6%, and we're going to run this again. Whoops, you're in trouble there. So this scenario is exquisitely sensitive to both your investment style for a younger person and inflation. So we're going to go back to that 89% one. And the other thing that has a marked effect on your outcome is the life expectancy. So let's, instead of dying at 95, let's die at age 90. And you don't need your money to last as long then. So we're going to run it again, and you go up a couple of percent by shaving 5 years off your life. I think that 95 is a good life expectancy to include in these kind of models. So we've run that. We've looked at some of the parameters. I would like everybody who's watching this webinar to go away, work out their expenses, and do this for themselves. So let's look at somebody who is 60 years old now. They're going to retire at age 67. We're going to keep some of, they've saved a lot more in their Emory retirement. They've saved $1 million in their retirement. They're not saving a lot at the moment, and their tax-deferred savings was 18. They're going to get 35 from Social Security, and they still want to spend $100,000 a year. So let's run this. And they've only got a 78% chance of making it. So you may need to, when you see this, then you need to make your average spending a shortfall is 36%. So you're going to want to take some action over the next 5 years. Maybe you want to reduce your spending and start saving $10,000 a year. And when you do that, you've increased your probability of success. that's still with an aggressive investment style. So you really want to decrease that investment style as you approach retirement. And the moderate risk is giving us an 83% probability of success. So let's up our annual savings another $5,000 a year and run it again, and we've got an 85% probability. So maybe you don't think you're going to be spending a lot of money when you're 95, so your requirement for money is you're going to drop your life expectancy to 90, and now you're looking at something that you can kind of live with. And so, but remember, this is very dependent on inflation. So we're going to up our inflation to 6%, and we are going to run out of money. Okay, so those are a couple of ways in which you can run these kind of scenarios. You can show, for instance, you can show your failures, the times money run out, and that's coming up on the right-hand side here. You can get more granular with some of the other inputs, and if you click on additional inputs, you can get very much more granular with additional details of your portfolio return, your start of your plan. You can specify additional cash flows and start year and end year, COLA, and put in these additional inputs to help you get more granular. It depends how much time you want to spend on this. And I think this is a great tool for everybody. I recommend that everybody runs it at least once a year. There's also look at the settings tab here, and you've got your spending policy parameters. You can return to work in the system. You can configure the order of which you take your money. So this is actually quite powerful, and I think is a really useful planner for people who are looking to retire. And even if you're not looking to retire, do this age 40 and update your plan every year. It's a lot cheaper to do this. In fact, it costs you absolutely nothing than getting a retirement, an investment advisor to do it for you. And as you can see, it's really simple to do. So I think I'll stop there again and take questions. If anybody wants to give me a set of input parameters, they could type those to Gray and I'll put them into the model. But if anybody else has got questions, we can go back to more questions about what I was speaking about earlier, or questions about the Monte Carlo system.
Okay, one comment is, I take it that one option is delaying retirement. For academics, 67 is an early retirement age.
Yes, if we go back to the PowerPoint, I did put that in there for 1 to 5 years to retirement, delay retirement. And that is really, you know, if you've seen your retirement savings be decimated by this year's stock market, then indeed you can delay your retirement, adding another year. So here, look at this. Let's go back to this model where we had 3% inflation, and run it again. And that's successful. Now let's look at a slightly less successful model. Let's take out our taxable annual savings and run it again. And we've got an 86% chance of success. But let's work for another 2 years. And we go from an 86% chance of success to 95. And so, yes, you can delay retirement. And if you want to know how much to delay retirement for, build this model for yourself and see what adding a year, adding 2 years, adding as many years as you want to will do to your probability of success. And this isn't a static situation. It's something that you need to do on a recurring basis to run this kind of plan yourself.
Okay, another question, how to make calculations if I want to live off dividends only and not touch the capital?
Well, I'm not sure that you can do you can look down here at the initial portfolio value and the median ending portfolio value. So this actually will show you what will happen to your capital if you do this. If you want to live on dividends only, then really this is not particularly helpful. You know what the dividends you're getting are. If you're getting $10,000 a year in dividends, then you can live on $10,000. But if you look at this scenario for this 60-year-old person, when they retire, they've got a portfolio of $1 million. They've got a portfolio of $1 million now. When they retire, it's 1.7. And the ending portfolio at age 95 is about 1.6. So essentially, your portfolio is staying relatively static over most of the runs, and your median withdrawal is at 4%, around 65,000. So you can use this to work out what will happen if you run on dividends only.
Right, and there was a modification to that by the questioner, meaning how much of capital do I need? Presumably, do I need if I want to live off dividends only?
It depends on the stock and how the dividends are being paid out. The problem with living on dividends only is you cannot be certain that those dividends are going to be there next year. I don't know, was Delta paying a dividend last year? I bet it's not going to pay one this year. So dividends are not entirely secure as a form of income. They are dependent on the performance of the company, and they're going to announce their dividends. I would bet if you've invested in an ETF that is a high dividend yield ETF, I bet next year the dividend yields are going to fall substantially or over the next year. So I would be a bit wary about being dependent on dividends for your retirement income because they're not guaranteed.
Okay, that is all of the questions that have been asked up to now.
Okay. I'll stay on. We'll keep this open for just 1 or 2 more moments in case people have any other questions. I will repeat that my email address is psebel@emory.edu. I'm happy to share the slide set. I'm happy to answer specific questions that you didn't want to ask in the seminar. And it's been a strange experience sitting in my home office giving this seminar. I want to thank everybody for listening. I hope you feel it's been valuable. I really appreciate your time, and I hope that you got something out of it. So, Gray, have any more questions coming?
One just came in.
Okay.
When are you going to take your cash and reinvest in stocks? and what are you looking for?
Okay, that's a good question. When am I going to take the cash, my cash, and reinvest? So, as I said, you can't time the market, and you shouldn't attempt to time the market. I was talking to a friend yesterday. He said, when should I take, I want to move somewhat to cash. When should I do it? Should I do it over 5 days? Do you think the market's going to go up in the next 5 days? I said, no, I don't know. You cannot time the market, but I think you can take a longer view of the cash that I have now. I am going to reinvest it when I see signs of economic activity, when I'm hopefully still alive at the end of this pandemic, and hopefully we start seeing companies gearing up again, we start seeing restaurants reopening, we start seeing the number of jobless claims decreasing. When we start seeing signs of economic activity, I would start reinvesting that cash. I wouldn't do it all at once. I wouldn't do it in one day. I would do it over a period of several weeks, if not months, of gradually moving a percentage of that cash back into the market. And I'm not going to get the bottom of the market, and I'm going to lose out on some upside because I'm going to be potentially miss the sudden jump up. That's okay. I know that I can go to sleep at night and not lose sleep over a market crash. Remember 1929? The stock market dropped 90%, a 90% reduction in the stock market in 1929. So,
and one comment came in. You need to reduce your pre-tax nest egg, or else your heirs are going to have a big tax burden, as they need to include your passed on investment into their income over 10 years.
Okay. I would like to die with a nest egg and let my heirs worry about that. At the moment, I'm more concerned with, can I afford to live over the next 5 years? And I'm not being flip about that. I think we need to deal with immediate situations first. If you've got a substantial capital balance in your estate, you need to take expert advice on how to deal with that. Remember that you've also got required minimum distributions from your retirement plan, which you need to take, and they are now starting at age 72. That changed in December. So you're required to take distributions whether you want to or not. As far as how to deal with a tax liability for your portfolio, that's a problem I would love to work out with my family. It's a problem I'd love to have.
And then a question, I think, relating to the current crisis. How long did the Depression last? Until World War II?
I honestly can't answer that. I haven't really looked at that. It was several years, wasn't it? I don't know if it went right into World War II. No, I think that as far as I remember, America was doing reasonably well before World War II, but I really don't, I'm not a historian and a historian of economic crashes. I can't answer that with any certainty. What you need to think about is not really what happened in 1929. What's going to happen now? Is this going to be a V-shaped recession? Are we going to come out of this stronger than ever in 6 months? Or is it going to be a U-shaped recession where we're going to have soup kitchens in New York for 3 years? It's going to be somewhere between the two. So it's going to go on for, this recession is, I'm certain, is going to be longer than 6 months, but hopefully it isn't going to be 3 years.
Oh, and then there is a response. Google says 10 years in terms of how long the recession lasted.
Well, yeah, the 1929 recession, yeah. Well, that lasted 10 years. How long did the 2008 recession last? That was really a solid 6 years or so. So, you know, when you see um, you know, economists predicting a V-shaped recession and return to full employment in 3 to 6 months, I would I think that's an unduly rosy view of what's going to happen.
Okay, that's all the questions. And what I want to say is to thank Peter very much for doing this. I think it's been really helpful, and to thank all of you who are still online. And I will be sending out information about how to access the recording of this when it's up on our website, which I hope will be within a few days. So thank you for attending, and thank you, Peter, very much for doing
and
this.
also, I would like to express my appreciation for all of you for you listening through this, for your questions, and also to thank Gray, who has done a significant amount of work in setting this up in practice seminars, and it seemed to work really quite smoothly. Thanks very much, Gray.
Okay, and we will be having another retirement seminar, and our plan is in another month, and I'll send out information about that and the topics closer to the time. So wish everyone a good rest of the day.
Thanks, everybody.